bumpy ride, and diversification does that. So owning across sectors, geographies, and some fixed income, that's going to be key.
All right, I see Jim nodding, so I'll leave it at that. And I appreciate the time for you both today. Jim Paulson, Neela Richardson, joining us, Tyler, on what is now about a 1,700-point drop for the Dow.
What did I do to stocks by coming back here in the studio? Maybe I need to go back to the kitchen, ladies and gentlemen. It's nice to be in the same room with you, Kelly, and with your next co-host, Wilfred Frost. Closing bell starts right now.
Tyler and Kelly, thank you. Welcome to the Closing Bell, everyone. I'm Wilfred Frost along with Sarah Eisen. A sea of red behind me as the sell-off accelerates. The S&P 500 down over 5%. The Dow worse than that, 1,700 points or so, over 6%. The worst day since March, with 59 minutes left of the session. Let's have a look at what is driving the action. A surge in new coronavirus cases in parts of the U.S., dampening hopes for a swift economic recovery. That's causing a sharp reversal of the reopen rally as travel and retail stocks like American Airlines, Simon Property, they're all cratering.
The station you're listening to is experiencing technical difficulties.
And after a dour forecast from the Fed, Treasury Secretary Steven Mnuchin digging in his heels on the topic of reopening, saying, quote, "We can't shut down the economy again," Sarah.
Worst day for the Dow since March. We've got a great lineup to help you navigate this sell-off. Former National Economic Council Director Gary Cohn joins us exclusively to talk about the market plunge and the growing stimulus debate in Washington. Plus, Guggenheim's Scott Minerd said last month there were, quote, more bubbles to come. He'll join us to weigh in on today's downturn. And the black swan of 2020, that's what Sequoia labeled the coronavirus pandemic back in March. We're going to talk to partner Roelof Botha about how he views the startup landscape right now. Let's get straight to the sell-off and our team of reporters to break it down. Mike Santoli tracking the plunge. Brian Sullivan focusing on the drop for energy stocks, the worst performers. Meg Terrell covering one big area of the market, for the market, the rise in COVID cases in some states. But Mike, start us off with the broader ugly action that you're seeing in this final hour of trade.
Yes, Sarah, the sell-off deepening here. We've been talking for a little over a week about how the market was a little bit overheated, a little bit stretched, traders getting perhaps a bit overconfident. There was an easy way to deal with that and a hard way. We've taken the hard way, which is a very sharp and violent flush, maybe the start of something deeper. I wanted to point out some stops along the way. By the way, the easy way would have been just to flatten out the rally and go sideways for an amount of time. That seems not the case. 30.17 is what we're trading right now, so we're below a 5% pullback. This run up, we did have 3 5% pullbacks, but only 5% along the way. So clearly that's deeper. 30.13, it's basically right there, is the 200-day moving average. That didn't give you any real resistance on the way up. It's unclear if it's going to break things on the way down if we were, in fact, to continue lower. Other points to look at. 29.80, oh, that brings the S&P dividend yield back to 2%, if that's interesting. That's been a little bit of a lodestar for the index over several years. And then 29.50, remember we were sort of stuck around there for a while? That's the breakout point. Maybe there's going to be tested. 10% is 2,900. So you can kind of stage it down there. Until you get to that 2,900 area, you're still in that zone of somewhat routine pullback. It does seem, though, as if right now this market tends to overshoot. It seemed to overshoot and be very persistent on the upside. So we'll see how deep things get. By the way, to get back to a 20 times earnings multiple, 2,800 and around 2,900 too. Again, I think this is a key area because we spent a lot of time in this zone last year. That's where the 50-day average is. In bull markets, pays to buy pullbacks at the 50-day average. We'll see if that's what we're in, guys.
Obviously, Mike, this is pretty broad-based. All 11 sectors are lower. What can you glean from where the pain is this most severe right now? The energy, financials, what other stocks are bearing the brunt of it? And what does it tell us about the why behind the sharp selling today?
And industrial. So it's an unwind of that cyclical trade that we saw over the prior few weeks, which was giving people a little bit of hope that the market was positioning for an acceleration in the economy. So we're having a lot of money drain away from there. It's a very defensive move altogether, right? You have big tech holding up slightly better than the rest of the market. And that's familiar when bonds rally and yields go down. That is the direction of movement. So it's obviously a rethink of the reopening is going to be smooth and strong type idea, but also just could be those sectors which were in deep downtrends had just bounced way too far in a hurry.
Mike, thanks so much for that. Defensive, certainly the operative word. The dollar is higher, gold is higher. Oil, though, moving in the opposite direction, down about 9.5%, and therefore energy, the worst performing sector on the S&P 500 today. Brian Sullivan having a look for us now at what's driving that move. Hey, Brian.
Hey, Wilf, well, what's not driving that move is us driving, I guess. I mean, the recovery may be a little bit slower than people think. That's one of the factors. All right, let's go through really the four things that are going on with oil and oil stocks. At number one, many people you talk to will say, listen, the recovery is already priced in. How much more do we want here? We're not going to get back to 100% normal anytime soon. This has come fast, and that's already priced in, number one. Number two, jet fuel. It remains weak. Jet fuel is about 30% of total global demand for the use of refined products. Guess what? Yeah, those TSA numbers, they're coming up, but they're still down 95% from this time last year. Inventories, don't lose sight of that. They are still high. Are they topping over the tanks? No, but they're still very close to that. More oil, by the way, continues to be imported into the United States. And from an equity point, guys, you got some stocks, not all, but some that are not only at, well above their analyst targets. You got ExxonMobil pretty much sitting at the average target. Occidental is $5 a share higher than the average target price of analysts. Look at the indexes and the ETFs that are getting whacked today. The XOP, it is down 8% exactly, but the OIH, that's much worse. The OIH is a smaller ETF, mostly composed of smaller services companies. So if you don't believe there's going to be a production recovery, avoid that ETF, because those are the companies that get paid when the Chevrons and the Exxons spend more. Capital spending, guys, as we all know, has come down. That's almost all services companies. That's why that is down there. But again, we have come back pretty quickly. The average big cap stock in energy is up 38% this quarter, despite the fact that a few days ago, the EIA cut their demand for 2021 forecast for the second time. So we look out, guys, we look at demand. Yeah, it's getting better, but we got a long way to go. Supplies are still high, and it's spooking the energy market today. By the way, if you tuned into our CNBC Pro event Tuesday, the guest that we had on said short oil and oil stocks, and he's an oil investor. I guess he's done pretty well. Well, indeed. Great timing on that particular call. Brian, my quick follow-up question, as you mentioned some of those smaller names, back in March, there was a big question mark about whether they'd survive or not. Has that risk itself gone up over the course of the last couple of days, or are we really just tracking, the equities just tracking what the oil price is doing, which, as we said already, is down sharply 10% or so today? It's a great question. I would say, and we talked about it on that pro thing again, but I would say the risk of bankruptcies has not slowed at all, because the way oil companies work, and I'll be very quick here, is that twice a year, banks come in and they look at the value of their reserve assets, the value of the oil under the ground. We literally just got through that first cycle when this COVID hit and oil prices collapsed. So, companies were able to sort of maintain that 6-month reserve value on their books. If oil stays low, guys, then in the fall, when the banks come back in, they're going to say, Frost and Oil and Exploration, or Eyes on Oil, you guys are valued 50% too much, because the value of your reserves has just dropped by 50%. And now you've broken all these covenants. And by the way, give us our money. So we're going to have to wait until the fall when that reserve thing kicks in, when they go back and look and revalue those oil assets under the ground. That's the key. It's really just kind of the stuff under there, Wilf, that matters. So we got a few more months, but the problems aren't solved. Brian, thanks very much for that. So energy is the worst performing sector. The second worst is financials. Banks getting slammed today, down over 7%. In fact, 8.5%. It's worsened significantly in the last half an hour. Down some 16% since Monday's intraday high, though this does come off a terrific 1-month rally, up about 25% from the middle of May. Now, why are we seeing this selling in the banks? Well, two main reasons. First, the Fed's clear commitment to lower rates for longer. Clearly, that impacts ability for banks to earn. Here are some of the names most exposed to net interest income. The exposures do match up year to date with their share price performance. Morgan Stanley, Goldman Sachs, for example, significantly outperforming Citi and Wells Fargo, for example. On top of that, banks are very much part of the bucket of cyclical value stocks that all year have been punished when fears over the economy and the virus spike, as they have in the last few days. In that light, banks down 7% or 8% now, when the S&P 500 itself is down 5.5%. You could frame as
Why isn't it even worse? Well, you could also frame it the other way. Why isn't it better when you consider that this week the tone from most management teams was constructive at the Morgan Stanley Financials Conference? Here is analyst Betsy Grassick's key takeaways from her conference. 1, consumer credit quality looks stable and deferrals continue to decline. 2, all card issuers seeing spend off the March and April lows. And 3, expecting most banks to maintain their dividends. That said, Wells Fargo was less constructive, is now expected to cut its dividend, and almost all of the banks do suggest that reserves will continue to need to rise in the second quarter, albeit to varying levels, but certainly a very big rotation today, Sarah, that continues, and banks very much in the eye of that storm.
Just on the blaming of the Fed, I mean, was it really a surprise that the Federal Reserve would keep interest rates low for as long as they committed to doing? I guess there was increased chatter around yield curve controls or yield caps, but I mean, was that really the big weight here?
No, and as we discussed yesterday with Mike, the kind of Fed futures and whether we're going to have rate hikes didn't really change. No one's expecting a rate hike, as you aptly say, and clearly there's always the potential for the Fed to decide to start hiking if things improve. Jay Powell can change his tune, but just look at what the 10-year's done. We nearly got up to 1% just 5 or 6 days ago. We're now down to 0.66%. And so whether you're saying you're tracking the expectations of rate hikes or rate cuts or not, they do always track what the 10-year and 30-year bond does. And there is the 10-year. That's just today. If they broaden out to a week or so, you'll see quite a sharp decline in that yield.
Yeah, there's also just not a V-shaped recovery talk today. It's more of an economic softness, and what is this recovery actually going to look like? We'll keep an eye on the banks, among the hardest hit. One factor weighing on the market today is a concerning uptick in coronavirus cases in some states. Meg Terrell has some details on the hotspots to watch. Meg.
Hey, Sarah. The hotspots people are really looking at are across the South and into the West. Epidemiologists pointing us to Florida, Texas, and Arizona in particular, although we're also seeing trends up in California and Nevada, Utah. Looking here at Texas, you can see the cases are starting to increase. That initial reopen at the end of April, them only ticking up from there. The red line here is the test positive rate. That's also increasing in Texas. So the increase in cases can't be described by increases in testing. You're also seeing infection spreading there as well. Looking at Florida, you're seeing a similar trend. After their stay-at-home order expired on May 4th, you're seeing cases increase. The test positive rate, although it is under 5%, it's also ticking upwards. And in Arizona, these trends are really the most pronounced. ICU availability is down below 30% there. The test positive rate's approaching 14%. And of course, you are seeing those cases tick up as well. And now, as we're looking at all of these data, a very high-profile model was updated today, the IHME model that's been cited by the White House. It has received its fair share of criticism, but this model does show that a second wave of deaths could start to happen in September. And this is all based on what we do from here, guys, in terms of our social distancing, our gatherings. And they say they hope to see their model proven wrong by swift actions of governments and individuals to reduce transmission. But as they do this modeling, they say the states with the earliest projected upticks in deaths are Florida, Arizona, Georgia, and Colorado. Guys?
I wonder how important the mask wearing culture is in some of these places, and also social distancing. You know, when we look at Europe and China and Japan and see that they have been able to reopen so far without any major surge. I mean, we also see pictures and hear anecdotes about the fact that they're following those types of rules, especially on masks. What are you seeing out west?
Yeah, I think there are definite cultural differences between countries. What's really fascinating to me is that places in the United States, you and I were talking earlier about Georgia and Florida, we're not seeing, you wouldn't imagine there are major cultural differences between those states, but you are seeing an uptick in Florida where you're not seeing it in Georgia. So we're just going to have to wait and see those data. But Sarah, I think you're absolutely right. Cultural differences, adherence to wearing masks, and social distancing guidelines may describe why different countries are seeing such different rates. And, the WHO just updating its guidance on mask wearing, saying we should be wearing masks, if we're wearing cloth masks, with at least 3 layers to them. And I think a lot of us probably aren't doing that. So a lot we can probably learn about that.
Meg, thanks so much for that. Quick check-in on the market. You can see down 6.3% on the Dow, 17 100 points. By the way, not inconceivable we could see the circuit breakers kick in. The S&P 500 down 5.4%. It would kick in if we were down 7% on the S&P 500, so still 1.5% away, and that would have to happen before 3:25 p.m. After that point, no circuit breakers, whatever the level of trade. We've got, 45 minutes left of the session, still ahead, navigating this sell-off. We've got a big lineup to help you make sense of the market downturn, including Double Line's Jeff Sherman, former National Economic Council Director, and Goldman Sachs COO Gary Cohn, and Guggenheim's Scott Minerd. You're watching Closing Bell on CNBC.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
With millions of podcasts dropping new episodes all the time, how do you keep up with all your favorites? TuneIn makes it easy. Simply head to the home screen and find your new episode section to see the latest additions.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Let's be honest, we all spend too much of our day on social media. But at least you can spend your endless scroll time to discover new things on TuneIn. Follow @TuneIn on Facebook, Twitter, and Instagram to always be in the know about the best new stuff streaming in the app. From breaking news stories and live sporting events.
Yeah, but it's unique times. I think there's unique circumstances, and we're trying to
standout stations and podcasts. Stay in touch with TuneIn.
Okay, here we go.
With the NFL draft in the books and the schedule set, check out a TuneIn podcast for daily updates on the lead up to the 2020 season. Like the Ringer NFL show, where a rotating cast of Ringer experts talk with players, coaches, and special guests about the NFL landscape.
A lot of the other teams that we consider...
Or ESPN's NFL Live.
If there are some delays because of the COVID-19...
Search sports on TuneIn to explore these pods and much more.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter, to Connor, to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening.
Where do sports, culture, and basketball nostalgia collide? On their podcast, Knuckleheads, NBA veterans Quentin Richardson and Darius Miles sit down with athletes, musicians, and entertainers to get brutally honest, totally unguarded conversations about everything, from current events to untold stories from the golden era of sports.
Kill O'Neal. You know that, right? I tried to tip dunk all the free throw line one time.
Search Knuckleheads on TuneIn to listen.
Stocks are plunging today. The Dow is down more than 1,700 points as some states experience an increase in coronavirus cases as they reopen from lockdown. Joining us for more on the sell-off, Jeffrey Sherman, Deputy Chief Investment Officer at Double Line Capital, and Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Good to have you both here. Jeff, how do you see the why for the magnitude of the selling? Are you pinning it on the Fed, on the cases, on just a need to pull back after an extreme run? What is it?
Yeah, I mean, it's an extreme run, I think, across all risk assets. And so if you look earlier in the week, we had the RSI, the Relative Strength Index, a technical indicator looking at the last 14 days of roughly half of the S&P 500 getting north of 70%, north of 70 read on that relative strength indicator. And what that means is that they're overbought. And so all it took was a little trepidation in the market to really get things going. And you could see how it really exacerbated as the days went on. And I think what you see here is that this is the Fed did what they could. They came out and said, look, we've given you low interest rates. We're telling you we're going to be low for a while. We don't have negative interest rates on the table right now. Maybe we do some form of yield curve control, but at this stage, what they want to do is communicate that we're going to commit to low rates for a long period of time, and that's our way of saying we're here to support the market. They're still doing $120 billion a month in quantitative easing. I put that in perspective. That's 50% higher than we did in quantitative in QE3. And so what the Fed has said themselves is that they've done all they can. But I think there's just too much optimism in the market. I was listening to the report beforehand, listening to the energy side, and you don't see the gasoline demand there. You don't see TSA traffic. There's a lot of pieces of the economy that aren't showing the V shape, but the markets had priced that in. So I think they're going to be susceptible to economic volatility as we get more data through. And as you'd mentioned, too, the virus cases accelerating in certain parts of the country is reason for concern here. And so it's something that the tone out there has been very, very bullish. It's been ignoring the economic data. And even Mr. Powell said himself, he's not looking at market performance to corroborate. He's looking at the economic data, and it just does not corroborate some of the V shape we've seen asset price recovery.
Jeff, in terms of what's priced in, clearly yields have collapsed this week from close to 1% on the 10-year to now down to 0.6 or so.
Yes.
What would you say is more likely, a rate hike again by the Fed by the end of 2022, or the Fed going negative?
Well, we've kind of dug our heels in. We hope the Fed doesn't go negative, because we've seen that experiment just not work in other parts of the world. And so I think that's the old quote that's attributed to Einstein. The definition of insanity is doing the same thing over and over again and expecting better results. So I'm going to say the rate hike would be more likely. But at this stage, rate hikes are on the table. The Fed, Jay Powell told you yesterday that regardless, they're not even thinking about hiking. He's trying to just nail that into investors' heads. So I don't blame the Fed for this sell-off. I blame the virus for it and the optimism that's out there. And, we see the death studies out there that talk about a second wave. This isn't a second wave. We're not through the first wave yet. And so when we look at anecdotal data, you look at the open table reservations, you look at the gasoline demand the EIA puts out, what you're finding is that we're just on the cusp of turning. Look, it looks like a lot of the worst is behind us, but it sure doesn't look like we're out of the woods yet. And I think that's what you're seeing there. So I'm going to say that still, I don't think the Fed wants to go negative. They know that it would really cause problems in the banking system here in the U.S. And given what we're the largest banking system in the world and the reserve currency, it'd be very challenging for us to weather that globally.
So, Dan, what are you guys doing? What is your investment advice? Is this the time to take profits?
I don't think this is a time to be swinging for the fences here. I think there's a tremendous amount of uncertainty on both sides. I agree with a lot of what Jeffrey said in terms of the risk, the recovery, which is why I don't think it makes sense to have a one-sided extreme bet to the upside here. But at the same time, I think there's a lot of positive things going on right now. I think in terms of the magnitude of the stimulus you've never seen before. And also, the fact that, Jeffrey mentioned that we're sort of hopefully finding a bottom here. I think the reality is, as bad as things are on an absolute basis, they're getting better. I mean, all the data you're seeing that you're seeing is telling you that. The data we got out this morning was telling you that. So my guess is that 6 months from now, things are going to be better than they are today, not worse, albeit at still bad levels. And I think that it's hard to be take an extreme bearish position when things are getting better. Remember, the market cares less about the absolutes of good and bad and more about better or worse. So yes, there are risks to the recovery. There could be second and third order effects that start to weigh on the recovery. But I think here, while things are getting better, you may have to be nimble. You may want to rent this with an option to buy this rally later. But I don't think it makes sense to be extremely bullish or bearish here in the position.
Dan, very quickly, if you had to pick one U.S. S&P 500 sector to buy today, what would it be?
From a sector perspective, I mean, my main focus was about balance. But I think if you want to play for the upside here, I think energy is probably most leveraged to the upside. But I do think you want to hedge that with some high quality or defensive positioning on the bearish side.
Wow, that's a bold call on energy. Jeffrey Sherman, Dan Suzuki, thank you both very much.
Thanks for having us.
We've got just a little less than 40 minutes to go before the closing bell. Stocks are sinking at this hour. The Dow is down almost 7%. The S&P 500 down 5.6. Only two stocks are green in the S&P, Cabot Oil and Kroger. Still ahead, Guggenheim, Scott Minerd warned in late May that there were, quote, more bubbles to come. We're going to get his thoughts on today's sell-off and whether he thinks it's just the start of a larger downturn. Stay with us here on Closing Bell, and as we head to break, a quick check on bonds. As we've been talking about, bonds are in demand. The safe haven trade is on, and that's pushing pressure on yields. 10-year yield, 0.65%. We're seeing the lowest levels there since early June. 2-year note yield, though, remains a bit higher. We'll be right back on Closing Bell.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
Ready for a one-of-a-kind look at the NFL? On the PFF NFL podcast, Steve Palazzolo and Sam Munson interpret the unique stats of Pro Football Focus to analyze the league, uncover secret superstars, and discuss which teams to watch out for in the next Super Bowl.
Let's talk some football. Let's do it, Steve. All sorts of stuff. We're going to do most improved defenses around the NFL. Solomon Wilcots, our very own. He went into some detail over at PFF.com. Most improved defenses around the
Search PFF NFL on TuneIn to listen.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show,
Welcome back. 34 minutes left of the session. Let's have a check-in on the markets. Markedly lower. The S&P is down 5.8%. As you can see, the Dow's down 1,850 points, set for what is likely to be the fourth worst points decline ever. The three worse than that coming in the month of March this year. That's down 6.8% now. NASDAQ down 5%. All of the S&P sectors are lower. The best performer, Staples, is down 3.6% itself. Energy, financials, materials, all down 8% or more. Let's have a look at some individual market movers. Shares of Starbucks are sliding after a downgrade at KeyBank. The firm says the coffee chain's current sales trend remained challenged and believe near-term upside is limited. And Grubhub bucking the broader trend today. That stock rising on merger plans with European food delivery company JustEatTakeaway.com. The deal values Grubhub at $7.3 billion in equity. It's up 4.6% or so. Uber suffering somewhat today because of missing out on that deal.
Yeah, and the overall market, too. After the break, we're going to talk exclusively with former National Economic Council Director Gary Cohn, his take on the sell-off and the debate over more stimulus out of Washington next.
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then, whenever you want to browse your favorites, you'll find everything under the Favorites tab.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back at the wall. It's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it over to Reese for one, back to Hodges. It gets away from him. Barrows trying to go to second.
It's on demand, it's free, and it's only on TuneIn.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, former NBA players Matt Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother,
Vince Carter, man. Welcome to the show.
Yo, what's up, man?
What's up, my brother?
Man,
Search All the Smoke on TuneIn to listen.
Wanna bet football can make you feel nostalgic?
Playing days are over, so...
On the podcast, NFL Alumni Lounge, Charlie Booth sits down with retired NFL legends to talk about their careers, life after football, and everything in between.
Mr. Darren Waller, good to have you.
Yes, sir, it's good to be here.
Dana White, welcome to the Alumni Lounge.
Thanks for having me, brother.
Big member of our NFL alumni family.
Money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
I'm Randy, and I run my fashion business on Wix. I went from brick and mortar, which I knew all my life, to online. We've always used Wix for a platform, but never really dove in to know everything that Wix offered us. Curbside pickup, online orders, collections, things that we've never been able to do before. I went from selling to my town to selling nationwide in 1 week. It's a whole new business now.
This isn't dry food or wet food. It's not burnt brown pellets. It's real meat and veggies, developed with vets and delivered fresh to you. Visit tryfarmersdog.com and get 50% off your first box of food.
Welcome back. Just about 30 minutes left until the close. We are looking at our worst day for stocks since back in March. The S&P 500 sector heat map is ugly. It shows pain in all corners of the market today. The hardest hit groups, energy, stocks there down 9%, financials down 8%, materials down 8% as well. Consumer staples and utilities, defensive plays holding up the best, but each are down almost or more than 4%. Here are three things driving the action and the selling in stocks right now. A surge in new coronavirus cases in parts of the U.S., dampening hopes for a swift economic recovery. That's causing a sharp reversal of all the reopening rally, travel stocks, retail stocks, United Airlines, Simon Property, both of those names cratering. And after a dour forecast from the Fed, Treasury Secretary Steven Mnuchin digging in his heels on reopening, saying, quote, "We cannot shut down the economy again." Wilfred.
As the country deals with new COVID concerns, the debate over more stimulus rages on in Washington. But new data shows there's still a surprising amount of funding left in the programs that have already passed Congress. Kayla Tashi has that story for us. Hey, Kayla.
Hey, Wilfred, more stimulus is a when, not if type of question. But as to the when of those talks formally getting underway, White House negotiators and Republican leaders on Capitol Hill are not expected to hold formal discussions over new stimulus until late July, after Congress returns from a 2-week recess. The reasoning is that existing programs are working, they're not expired, and they're far from fully spent. Out of $2.8 trillion allocated in the last 3 packages, about $1.5 trillion has been dispersed. That's according to White House budget data provided to lawmakers and obtained by CNBC. That number will go up when the Fed's new lending programs get underway. But as of this week, programs like expanded unemployment insurance, FEMA disaster relief loans, and reimbursements for hospitals still had about 2/3 of allocated money left. Earlier today on CNBC, the Treasury Secretary said as that money starts to get into the economy over the next month, that should help until new aid is authorized.
There's only about $1.6 trillion of that money actually in the economy. So, over the next month, you're going to see over another $1 trillion pumped into the economy. That's going to have a big impact. We have the Fed program. We have Main Street, which is going to be now up and running. And we're prepared to go back to Congress for more money to support the American worker.
Of course, the strategy of waiting until late July relies on another upbeat jobs report coming out for June. That report is due out on July 2nd. Wilf and Sarah, back to you.
Kayla, thank you very much for that. We've got 27 minutes left of the session. We're down 7% on the Dow. We're going to be commercial-free now right up until the close, so you don't want to turn away anywhere else. And joining us now to discuss these crazy markets we've got on our hands today, National Economic Director Gary Cohn joining us in an exclusive interview. Gary, very good afternoon to you. Thanks for joining us.
Thanks for having me, Will.
What a turnaround in sentiment from Friday's jobs report, which was much better than expected, to what we're seeing today. And part of that coming, I think, because the Fed chair struck a fairly downbeat outlook yesterday for the economy, certainly compared to Steven Mnuchin this morning on our air. Where do you stand in that particular debate on the economy?
Look, I don't know if Chairman Powell was really downbeat. I think Chairman Powell was trying to be realistic to what the Fed is seeing in the economy. Remember, we're still in a recovery period from an unprecedented time in our history. And the way this recovery is happening is really bifurcated. You've got the large companies in America, which is the Dow or the S&P, and they're seeing one set of circumstances. They're seeing a fairly robust business environment within to operate. And they're seeing, customers almost being forced to them because their local Main Street competitors have been shut down. On the flip side, you're seeing small businesses in America, especially small family-owned businesses, minority-owned businesses. They're still not open. And even to the extent they're open, at least where I have been recently, they're open on a very small scale. They're open for curbside only, or if you're in the restaurant business, you're open for outdoor seating only, with very limited amount of availability. So we are really seeing a bifurcated economy. And I thought that the chairman of the Federal Reserve yesterday tried to portray a realistic picture of what we're living through.
Do you think the market overshot it, Gary, on the optimism?
Look, markets always overshoot. We probably overshot on the downside, and we probably overshot on the upside. So if you look at where we are right now, we've come back down around 8% or so from the highs, but we're still up over 35% for the lows. We're in the period where we're trying to find a relative fair value for equities. That doesn't mean they can't go lower, and it doesn't mean they can't go higher. We're trying to digest right now what value should be.
I want to play another clip quickly, Gary, from Secretary Mnuchin's appearance this morning on Squawk on the Street, separate from what Kayla played earlier. Let's take a listen.
We can't shut down the economy again. I think we've learned that if you shut down the economy, you're going to create more damage, and not just economic damage, but there are other areas, and we've talked about this, of medical problems and everything else that get put on hold. I think it was very prudent what the president did, but I think we've learned a lot.
Gary, do you think that's accurately priced into markets, the idea that it would take an extraordinarily big spike in cases and deaths to see the economy shut down again?
Look, I think what Secretary Mnuchin said today is what the vast majority of people are thinking. We did what we thought was completely right with the information and knowledge we had back in March. Now that it's June and going forward, we have a different set of information facts. And as we see new outbursts of COVID or we see new spread, we're going to treat it differently, knowing what we know now. We're much smarter today than we were in March. We're going to attack it differently. We're going to change the way we react. We're going to do different things in the economy. I do think the market is understanding that.
I'm not sure we're past the first wave, though, Gary. I mean, one of the concerns out there is that, these cases are spiking in Texas and Arizona. And, in Arizona, the hospitals are starting to get full. We're not even in the fall where the medical experts were warning of the second wave. So I think the question is, do we have to recalibrate the expectations for the economic recovery if consumer behavior starts to change as some of these states still deal with the surge?
Sarah, I don't think anyone has declared the first or initial wave over. I think we're in a continuation of the first wave. It's taking longer to go away. But look, we're diversifying the virus. It's spreading out. It's now in different states. It's not concentrated in the Northeast. It's now concentrated a little bit in the Southeast or Southwest. So it's moving geographically around the country. But we're still in the first wave, and no one has ever declared the first wave over. I think we're all trying to guess what's going to happen in the fall. It just may be one long continuation with spikes and then subsiding and then spiking again. But the question is, what's the amplitude and what's the magnitude of those moves? Have we seen the highest spike? Hopefully we've seen the highest spike, and future spikes are going to be much lower than what we've seen in the initial wave.
Gary, I wanted to switch focus a little bit and talk about the banks and your old shop, Goldman Sachs in particular. Earlier this week, Monday or Tuesday it was, nearly went positive for the year so far, the share price did. Does that make sense to you? I mean, I know we're selling off today, but does it make sense to you that Goldman Sachs and Morgan Stanley, for that matter, could be flat roughly year to date? Are they going to have very profitable years despite the turmoil?
Look, I'm going to speak about the banks in general. That's all I know is the banks in general. Look, there has been a lot of lending activity going on in the corporate world. So banks involved in the corporate world, the corporate finance world, both in the equity capital markets, debt capital markets, they have been pretty active in spite of what's going on. There's been an enormous amount of capital raised. So banks are quite busy in their corporate business. On the consumer side, we're also seeing more activity. Activity has come off the recent lows. And I think you saw most of the bank CEOs in some of the recent conferences say, look, based on where they think the economy is now and what they hope the economic data is going to look like and unemployment data is going to look like going forward, they think they're close to properly reserved. If they're properly reserved or close to properly reserved, banks could continue to do fairly well going forward. But remember, we're in a different economic environment than we've ever been in before, so no one knows for sure what the future holds. Banks are serving their clients every day. They're lending money where they see appropriate, and they're serving their clients, and there is activity going on.
Well, a lot of that activity, Gary, though, isn't it due to the fact that the government, to their credit, moved really quickly to disperse relief in the form of the stimulus checks and the PPP small business program? I mean, these programs do run out. The extra bump in unemployment benefits. We're looking to the next few months when some of these programs have expiration dates. Then what's the economy going to look like if they don't get extended?
Sarah, absolutely. Look, the government stimulus program that they put in was completely necessary, and we should all applaud the ability for the government to move quickly and get involved in the economy and send the stimulus out. You're right. Many of these programs have relatively short duration. The original PPP money was 8 weeks. And so if you were a company that got original PPP money, you could be at the end of that money, and you could literally be running out. So the numbers that we saw last week in the unemployment numbers, they may look different a month from now when the companies that took original PPP money were able to keep their employees on. They may not be able to keep their employees on without future money or without some more expansion of the economy, which I don't see happening that quickly in the smaller businesses that were able to take the PPP money. So, look, I believe, like I think everyone else, the government's going to have to come back with another round of stimulus. We're going to learn from the first couple rounds of stimulus what worked, what was necessary, and hopefully the government will follow up on those programs that work with additional funding.
Finally, Gary, when you were in the administration, there was plenty of reports about how you were upset over the way that the president handled Charlottesville, the both sides comments in particular as it related to white nationalist protesters. We're reliving this a little bit on some of the race issues. When the Atlanta mayor said that President Trump's Lafayette Park cleaning was like Charlottesville all over again, I mean, did that resonate with you? Do you expect resignations from the administration?
Look, I don't know what to expect from the administration. I think each individual working in the administration has to make a decision for themselves if they want to be there, why they want to be there. Can they do more good by being in the administration than not being in the administration? And these are very personal decisions. Many people go to work in administrations to serve their country and serve the citizens and try and make America a better place for everyone. And these are tough decisions to go into administrations and leave your current role, and they're even tougher decisions to leave.
Gary, thanks for joining us.
I guess what I'm wondering is, what were you thinking when you saw that Lafayette Park episode?
Look, it was tough to watch many of the things that we've been forced to watch, and look, deservedly forced. And I'm glad that we were forced to watch these things in the last couple of weeks. We as a country are going to come out better for having gone through this, but now we have to make the changes. We cannot let this just be an isolated moment. We have to use this as a leveraging moment for the history of the country.
We will indeed leave it there this time, Gary, and we appreciate, as ever, you coming to join us in your candor. Thank you.
My pleasure. Thanks.
Dow down 1,700 points. Worst day for stocks since March. Let's get more on the big movers in these final minutes of trade. About 17 minutes left. Payment companies selling off in a big way today. Kate Rooney has all the details. They've been such big winners, Kate.
That's right. Hey, Sarah. So the payment stocks taking a hit today on fears of another consumer spending slowdown. Amex seeing the steepest losses, down about 7% heading into the close today. MasterCard also taking a hit. Visa slightly outperforming those two, but still a 5% loss. Payment volumes had been improving in recent weeks, but cross-border payments could take another hit if the global economy doesn't reopen at the pace analysts had been expecting. Square also underperforming markets. Today, that company is heavily indexed to small business. And PayPal faring slightly better. That stock is more tied to e-commerce than brick and mortar. It's still down about 4%. Back to you guys.
Kate, thanks so much for that. Meantime, the Nasdaq is pulling back sharply from its record highs, as are the names that drove it there. Josh Lipton has a closer look for us at the tech sector. Josh, over to you.
So, Wilf, let's break it down by sector here. Start with the semis, the SMH, the ETF that tracks that sector. It's in the red today. Though remember, certainly this is a sector that had rallied hard, surging more than 50% off its March lows. Notable laggards, though, in today's trade, AMD, Micron, Qualcomm, Applied Materials. More broadly, if you look at the tech sector of the S&P 500, notable laggards today, you'd call out IBM, HPE, and Xerox. Those names, though, have also lagged the sector this quarter. And finally, a relative bright spot to mention, the video game publishers, EA, Activision, Take-Two. Earlier today, EA actually hitting a fresh 52-week high. Given the pandemic, investors betting people are going to still look for more entertainment at home. Guys, back to you.
Josh Lipton. Josh, thank you. Shares of Boeing getting slammed today, giving up a big chunk of their recent gains. Phil LeBeau covering that move for us. Phil.
Sarah, shares of Boeing have gone down 25% since Monday. Since Monday, they've lost a quarter of their value, under pressure again today, along with the rest of the market. One piece of news that is getting some attention, Boeing supplier Spirit AeroSystems out with a note late last night saying that they were asked by Boeing to suspend current work on 737 MAX fuselages. They're working on about 16 of these. They already have 100 of them that have already been built, already paid for by Boeing. So as they get rid of that backlog, Boeing has said in the meantime, you know what, let's slow down the work on these future fuselages. So that's about 3 weeks worth of layoffs for some of the workers there in Wichita. That's the only new news relative to Boeing that might be moving the stock lower. But guys, it's getting hammered like the rest of the market today.
Thanks very much for that. As you say, the rest of the market getting hammered. We've only got 14 minutes left of the session. We're down 6.4% on the down. We're now in the closing bell market zone. Commercial-free coverage of all of the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got CNBC contributor Stephanie Link as well. Let's kick things off with the broader markets plunging today as economic concerns and rising coronavirus cases take center stage. The declines have steadily grown throughout the day, with the Dow now on track for its worst day since March 16. We're down 6.4%, 1,700 points. The low is down just over 1,800 points. 3 worse days than that in history, all down more than 2,000 points, which all came in March. All 11 sectors sharply lower. And Mike, we opened down, 700 points or so, and it's just been steadily sliding throughout the session.
It has, although bounced in the last 10 or 15 minutes, just modestly anyway. And I mentioned an hour ago or 45 minutes ago, that the 200-day average of the S&P 500 was 3013. We kind of toggled below that. Now we're above it. Don't know if that's significant, but clearly the takeaway is a lot of the recent winnings have been handed back to the house. Market was slightly overextended, as everybody was saying. That was not a novel observation. But instead of just flattening out, we have pulled back, and I think that you can fairly say this rally has really broken stride. Doesn't mean you have to go that much deeper than this, but a lot of the last little push higher was mostly about, wow, this market acts so well. Wow, look at the market breadth. Wow, nothing really gets in the way of this rally. And once you've kind of changed that psychology to we had this sharp, nasty cleanse of a pullback today, then you have to reassess. So just for context, the S&P is now back to about where it was Memorial Day. So you've kind of just skimmed away that final upside move during the month of June, guys.
Yeah, it happened very quickly, though, Stephanie. What are you doing on a day like today?
I'm watching on a day like today. Look, I think we were very much due for a pullback. And just to put it into context, I mean, from the lows in March to the most recent peak before this recent correction, the S&P was up 44%. But the industries, they actually were up much different. Some sectors were up a lot more. Like energy was up 100% from the trough to the recent peak. The industrials up 58%. Even technology up about 48%, financials up 52%. So all of these sectors did a lot better than the market overall from trough to peak. And so we were looking for probably looking for a pullback or an excuse for a pullback, rather. I do think the Powell commentary, there was nothing new yesterday, but of course it was definitely some cold water on the macro. The COVID cases, I think, on the rise, probably more important, more concerning to me. But just back on Powell for a minute, I mean, he has been saying since they announced unlimited QE that they would do whatever it takes. They're going to be accommodative. They're going to keep zero interest rates for a while. They're going to do whatever they want on QE and until they hit their mandate, with their mandate being full employment and 2% core inflation. We're nowhere near those levels right now. So, of course, it's going to continue. The important thing, though, Sarah, is that liquidity will continue. M2 is up 25% in the last month and a half. So this is really big news, and it is positive for risk assets. Doesn't feel like it today. Maybe we stall out a little bit. Let's watch the COVID cases. They're on the rise. But let's also not forget Moderna is making progress. J&J is making progress. Regeneron is making progress, all on the vaccines. So I think that we've got to keep it all into context. Again, we could maybe pause here. I'm just going to wait and let the dust settle and see where we are on these vaccines and testing and that sort of thing, because I think that is the thing that could put a wrench in the markets, in the economy, and in the recovery, more so than whatever Powell said yesterday.
Absolutely. We had good news on all three of those companies in vaccines and treatments today. Airline stocks taking a beating after massive run-up over the past few weeks. Joining us now, Wolfe Research Senior Airline Analyst Hunter Kay. Hunter, welcome to the Market Zone. Thanks for joining us. You made a good call at the end of May, upgrading the airlines from underweight to neutral. They've had a nice little run here. What do you do now? They're really in the eye of the storm.
Yeah, I think you wait. Honestly, we upgraded. We had been market underweight the airline space since December of 2018 because of classic late cycle behavior. That's excess supply growth, negative incrementals. Obviously, didn't predict coronavirus, but the call ended up working sort of by luck because of that. And then we just felt this sort of tide turning. We felt the same thing you guys felt. We saw the data, the same data you guys felt. And I know this space well enough to know that when you have this sort of momentum, even if it is just sort of like first derivative, thoughtless type volume being thrown at the space, we've seen that work before. The data was changing in front of us. Couldn't really deny it anymore. It was too late. It was time to not be negative. Now you probably have to wait. I don't know if this recovery is real or not, but the fact is the airlines are not taking permanent actions to take the supply out of just yet. So it's either too early or they're going to take the capacity out and things are going to be good, but it's going to take probably a few months to know.
Are there long-term implications from this work-from-home phase for things like business travel?
Yeah, that's a good question. We're all wondering the same thing. I mean, ask yourself how much you're going to travel. I think that's probably as good of a test as any. I think the recovery for business travel is going to certainly be slower. We have U.S. airlines adding capacity getting back to 2019 capacity levels by 2022. But we don't have industry revenue back until probably 2024. And the reason why there's that lag is because we expect business travel to recover more slowly than leisure travel. So there's a pricing mix that you're going to see manifest itself through the revenue line. I would imagine probably some permanency of business travel being destroyed will probably occur for a very long haul travel, particularly for those trips that are multi-days and a real grind in different time zones. Those might not have to happen anymore. Maybe it's 10 to 15%. At this point, nobody really knows.
Are there dislocations, Hunter, when it comes to the valuations in the different stocks? In other words, it feels like one big trade now, but are you distinguishing between the airlines based on their debt or their exposure to certain types of travel and seeing any opportunities for investors there?
Yeah, we have 4 outperforms, 4 underperforms, and 3 pure performs with a market neutral weighting. So we're very, very balanced right now. But I would say, I really reject this sort of like overly simplistic narrative of, oh, you want to be long low-cost carriers or you want to be long domestic carriers because that's where the recovery is going to be. You really got to think past that. That's not that smart. It's not going to make you money in the long run. If it does, it's by luck or on a very, very short-term basis. The stocks that we rate outperform have one common characteristic, and that's an established track record of cost control, good execution, strong and aggressive management teams to go out and take cost out in the event that this recovery is a little bit slower than people might think it might be. So, we like Air Canada, we like Copa, we like Alaska, we like Southwest. There's really nothing similar with those four airlines other than this long track record of cost and execution. So, and the valuation, of course, we're valuing them on 2022 earnings with a pro forma year-end 21 balance sheet look, given how much debt everybody's raising. And in some cases, there's significantly negative equity value for some of these airlines. But for those four that we rate, we do see some modest upside from a valuation perspective once you get through 21, which is going to be a transition year, surely.
Hunter, thanks so much for joining us.
All right, thank you.
The retail sector getting hit hard today as well. Courtney Reagan has those details for us. Hey, Court.
Hi, Will. So with consumers spending 70% of U.S. GDP, any recovery is going to be very dependent on the consumer, employment, and their ability and desire to spend. Take a look at the department store space today. Even though Macy's CEO said right here the early reopening is better than he had expected and improving, it's still well below pre-pandemic levels. Department stores, as you know, already downtrending, and many predict that enclosed mall-based formats are going to be among the slowest to recover here. Nordstrom shares down more than 12%, Macy's off 15%. Then you've got other mall-based apparel players. They're really selling off today too. Gap down more than 8%, along with Tapestry, Capri Holdings down almost 14%. Again, a lot of those in enclosed mall space selling discretionary items that just aren't high on priority list right now. Athletic retail stocks, those are losers too. Yes, athleisure is still hot, but there is lower demand with youth sports canceled, adult exercise classes sidelined, and just not going to the gyms regularly like perhaps we used to. Back over to you guys.
Court, thanks so much for that. Everything down today, apart from Kroger. Kroger is the one stock that's positive on the S&P 500. But Mike,
know why?
No, go for it, Sarah.
Food inflation is rising. It's the only pocket of the economy we're seeing higher prices right now. Kroger comes out with earnings in a week, Wilfred, and analysts are expecting double-digit sales, a big turnaround in Kroger's business as a result of all the people that are out there that are cooking and eating from home because they have to and because they're getting more used to it.
Well, there we go. Kroger is higher today, the one stock on the S&P 500, and Staples, Mike, the best performing sector, but still down nearly 4%, which kind of it really speaks to the level of selling today.
It does, and it really the comprehensive nature of the selling. So it's very much a purge of just general indexes, with the stuff that was up the most also taking the brunt of it, because they really did run mostly on hopes and just the spirit that we were going to be playing this reopening trade, and that included those more traditional retailers, absolutely, and as well as the airlines.
Well, one other part of the market, Stephanie, that I wanted to bring up with you are the transports. They're getting hit really hard. And you might think, because the airlines are part of this. But Matt Maley at Miller Tabak points out that the railroads and the trucking companies are actually getting hit even harder than they did before. In other words, there is an economic worry story here beneath the Dow transports. It's not just the airlines getting clobbered.
Well, it's the airlines, it's Boeing, obviously that's a big one too, no, I mean, I think that, look, they actually had a nice rally. As I mentioned early on, the industrials as a whole have rallied almost 58% from trough to peak, most recent peak. And so they really did do quite well as the cyclical trade did, people got excited about, myself included, by the way. I would say this about rails, different than trucking. I'm not crazy about capacity on trucks, on pricing power and that sort of thing. But on rails, I actually think there is a story where these companies can actually do a better job on cutting costs and being more productive. I own Union Pacific. I actually had been adding to it in March, April, May. I actually also think it's very important to watch the auto production restart, because that is actually going to help the rails in a big way. And I don't think a lot of people are talking about that. So they have they have self-help, if you will, some of them, not all of them, but some of them have self-help. And they also have the reopen part of the economy and that kind of exposure. And oh, by the way, some of them, like again, Union Pacific, very good balance sheet, and that dividend is covered. So I would be inclined to add to that one on pullbacks.
2 minutes to go in the trading day. Mike Santoli on the market internals. Breath looks bad.
Very bad. It's really a washout. Something like 95% of all New York Stock Exchange volume has been to the downside for most of the day. That's really a reversal of what we've seen, the past couple of weeks when we had these very strong up breath days. So lot of spill back there. The equal weighted Russell 1000 is down 12% in 3 days. So the average stock has absolutely had a good flush here. This is the high yield market against the treasuries. As you can see, the high yield coming back in price. So that would mean the credit spread's going wider. That's also kind of a flight away from some risk right there. That's a reconciling of that relationship to some degree. The VIX, big move today. Look, a 6% move in the S&P is always going to pop the VIX, but this now looks like it threatens to become a little more of an uptrend, or at least certainly the end of that downtrend. 40 is a pretty juiced number. If you see that decline tomorrow, let's say we get a bounce tomorrow that comes down by at least 3 or 4 points, that's actually going to be, to some people, a tactical buy signal. So just keep an eye on that relationship as the rest of the week goes on, guys.
We've got 45 seconds left of the session, markedly lower, as we've been telling you throughout this past hour. 1,855 points on the Dow, 6.9%. We were down 1907 at the low, so we're there or thereabouts as we stand. S&P 500 there, as you can see, down 5.8%. NASDAQ Composite down 5.2%. The Russell Index of small caps down the most, 7.5%. All 11 sectors of the S&P sharply lower. Staples, the best performer, still down close to 4%. Energy down 9.4%. Financials down 8.2%. Citigroup's down 13.5%. We've got a stronger dollar today, a weaker oil price, stronger gold price, and sharply lower stocks at the close, down 1,854 points. 6.9% on the Dow, S&P down 5.9%, and the NASDAQ Composite down 5.3%. Sarah.
Just brutal day for the bulls, and an ugly close to boot. Welcome back to Closing Bell. If you are just joining us, I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC Senior Markets Commentator. Take a look at how we finished up the day on Wall Street. The Dow falling 1,861 points, a drop of almost 7%. That was the worst day for the Dow since March 16th. S&P 500 also falling hard. Every sector getting slammed in the S&P. It closed out the day down 5.9%, just about at the lows of the session. As for the tech-heavy NASDAQ, which had been outperforming all year, it did hold up a little better than the rest, but still a sharp drop of 5.25%. And the Russell 2000 index of small caps slammed, down 7.6%. We have not seen a day like this for stocks in months, and it comes after a dramatic run-up from the March lows that we had already seen, more than 45% for the overall markets, taking it back on a day like today. Coming up, he called coronavirus the black swan of 2020 back in March. Coming up, we're going to ask Sequoia Capital's Roloff Botha if he thinks the market could retest amid a surge of virus infections and what it all means for his venture capital world. Plus, we will ask Guggenheim's Global Chief Investment Officer, Scott Minerd, whether this 3-day sell-off is an opportunity to buy back into the market. But first, let's talk about what just happened. Joining us, CNBC Senior Markets Commentator Mike Santoli, CNBC contributor Stephanie Link, and BlackRock Global Chief Investment Strategist Mike Pyle joining the conversation. Mike Santoli, first to you. You know, it had been a steady and slow grind higher, and then bam,
Yep.
This just hit the market like a ton of bricks. What happened?
It did. You know, not a single thing happened, except we could all say that the conditions were in place for some kind of a pullback. I don't think anything necessarily said it was going to be 6% in one day, but this market has been prone to these extreme one-way moves on a given day. The S&P was up 1,000 points, almost exactly from the March 23rd low to the high on Monday, 32.32. So up 1,000 points. It's now down a little more than 200 of those points. So, you in that context, we gave back 20% of a massive rally. That isn't in itself telling you that there's a trend change. But I do think that a lot of the other indicators, what happened with bonds, shows you that we might be bracing for a little more storminess as the summer gets going. Maybe it's just going to be a volatile range all the west. But we wiped away a lot of the froth in a single day, really 3 days, 2 of stealth selling and 1 of outright liquidation today.
Steph, you said you were doing a lot of watching today at the kind of mayhem as it unfolded. Is it very hard to step in and buy today when you're seeing the selling, even though there's stocks that you've been wanting to buy at higher prices? Did you manage to do that, pull the trigger and top up on anything?
Not today, because I just want to let the dust settle. I don't know how long this is going to last, but I do have a list. We talked about Union Pacific before. I have mentioned Wynn Resorts. I mean, that stock got hammered today, and I don't think anything in that 8K was anything new in terms of Macau. I still love Target, as you guys know. Costco. By the way, Target and Costco, Walmart, they actually outperformed on a relative basis quite nicely today, and they did what they're supposed to do. So we go back and we talk about this barbell all the time, right? You do want to have some quality, some growth, some defensives, because on a day like today, you got to stay in the game. On the flip side, when I mentioned earlier, energy, industrials, financials all outperformed meaningfully the S&P from the lows. You want to have exposure there too, because that's where you're going to get your alpha if you do see a recovery. And I am still in the camp that we will see a recovery, especially if we get vaccines in the fourth quarter. That sets up a very nice 2021 scenario in terms of growth and profitability.
Mike Pyle, is today the kind of day that makes you rethink things?
So I wouldn't say rethink. Indeed, I think that what we've seen, in terms of the outperformance of the U.S. versus the rest of the world, in terms of the outperformance of quality and growth versus the cheaper kind of value-oriented names, that's kind of most of what we've seen through this period of the coronavirus shock. And insofar as we continue to think uncertainty is high on a fundamental basis, as we look through the remainder of 2020, that's what the data around the coronavirus has said over the past couple of days. That's what the Fed was saying yesterday. We think those themes, in some ways kind of re-announced themselves today after this period of very significant cyclical outperformance the past couple of weeks.
Let's just pause the discussion and recap what was a roller coaster, crazy day for the markets. Bob Pisani has a summary. Bob.
And Wolf, this is very simply a reevaluation of the cyclical value reopening story. And you can see that in what's down the most today. If you just take a look at the sectors, bank stocks, energy stocks, airline stocks, retail stocks, leisure and hospitality, that's PEJ, that one there, fourth from the bottom there. At the travel and leisure stocks, we scratched our heads for a long time debating what goes on with United Airlines going from $30 to $50 in 3 days, and now all the way back down. It's like an inverted V for United and most of these other travel and leisure names that were very popular with the retail crowd here. Frothy? Well, you tell me if this is frothy. Airlines went up 80% in a little bit less than a 3-week period. Oil service stocks went up 70%. Banks went up 50%. Leisure and entertainment stocks went up 50% in a less than 3-week period with these kinds of economic conditions. A lot of people said, I don't quite get it. And now we're seeing the market trying to correct itself. Defensive names, Kroger was one of only 2 stocks that went up in the S&P 500 today. And you can see the other ones are down still, but not as much. So a relative outperformance. Curiously, the utilities did not really do that well here today. You think yield curve flattening, that helps bond proxies. But utilities had their own rally in the last month or so, up about 14%. So maybe a little, even here, let's take some profit. So let's evaluate what's moving stocks here. Remember those 4 buckets we always talk about? Valuation, is it overvalued or undervalued? Obviously, the market today said it's overvalued. Is the reopening, what is it? The Fed said it's not really a V, but we don't know what it is yet, and the market's having a problem with that. These are your 2 problems. The other 2, the stimulus, I'd say, is neutral. The Fed's still supportive, and treatment of vaccine, there's definitely progress there. The only other issue is, of course, the China issue, and again, they're neutral. Not a lot of news on that. So 2 of the whole pillars that we're basing this rally on, the valuation and, of course, the rollout, very much in question right now, and whether or not this is going to take a lot longer to get that recovery going. Guys, back to you.
Thanks so much for that. Mike Pyle, just wanted to come back to you in terms of this balance we've got between growth and value. Is it sort of either or now for the next couple of months?
We very much think that given the fundamental uncertainty we see in the kind of period ahead, that sort of orientation towards quality, towards growth is, against the full backdrop of things that could occur over the next month or two, the better place to be positioned. That isn't to say that there aren't going to be periods where value does outperform. That isn't to say there aren't going to be periods when there's a good deal of optimism. But kind of given the full range of outcomes we see out there, on balance, quality, growth, those are going to be better bets.
Mike Santoli, we saw some sharp moves across assets, really impacting stocks. Oil prices plunging. I mean, it was a pretty brutal day. Where did we end? More than 8% lower. Bonds surging, yields under pressure. What stood out to you? And what was the discussion as far as it impacted stocks?
The bond rally started with the Fed meeting yesterday. I mean, that was one of the moves that was pretty pronounced and decisive after the Fed, and it continued today with bond yields getting down below 0.7% on the 10-year, that flattening action. And that seemed to just set the tone as people were prompted to just rethink this kind of idea of an accelerating economy and all that involves in terms of oil and demand for gasoline and everything else. Now, oil was also one of those, asset classes that really had this wild ramp. You go from negative $40 a barrel to positive $40 a barrel in the course of, a month and a half or something like that is obviously a little bit removed from the underlying reality. But I do think that it was all of a piece, and also credit spreads widening out, not friendly for equities either.
It was so brilliant, Mike, what you were saying there, that they had to put some background music in.
As long as they don't want me to dance.
Yeah. Stephanie Link, want to come to you in terms of one other sector and stock which you didn't mention as clearly, I think, in your earlier list for potential buys and banks. Citigroup down 14% today. Bank of America down double digits, down 10% today. Would you want to buy those, or was the Fed share yesterday so dovish that you just think it's going to be impossible to make any money in the next couple of years?
I think you can be selective in the financials. You know why I like the Wells Fargo story, because you have a turnaround story. You have a new CEO. You have a well-capitalized company. I've also said even if they cut the dividend, I'd be fine with that. They cut it in half. You're still at about 3.5–4%. I really do like Bank of America because they have done such a good job on executing their responsible growth strategy. And they actually have always kind of lagged on the dividend front. And now they're quite competitive in terms of the dividend yield. And again, I think it's very well covered because they're very well capitalized. I still like American Express. That's a, getting back and going on the economy kind of stock. But it's trading at 13 times forward. It's got a great balance sheet. And it has an amazing global brand and a good management team and a good balance sheet, again, to cover that dividend. So there are places where I absolutely will look. If we're down again tomorrow and these things are down another 4, 5, 6%, I absolutely will be nibbling. But I'm in the camp that 2021 is a better growth year than this year. That you throw away this year, you normalize earnings, you look at capital levels, you look at dividend yields, and that's how I buy these stocks at this point in time.
Stephanie Link, Mike Pyle, thank you both for joining us. Appreciate your time.
Thanks, guys.
Venture firm Sequoia Capital. Let's talk about Silicon Valley. Sequoia Capital has invested in nearly 15 seed and Series A companies since March. This after issuing a warning to its portfolio companies, calling coronavirus the black swan of 2020. Joining us now is Sequoia Capital partner, Roelof Botha. Thank you for joining us, Roelof. So back in March, you called it the black swan of 2020. I mean, the market is still 37% off those March lows, but a day like today where we saw such a sharp plunge in the stock market makes you really wonder what the outlook is. How are you guys seeing it?
Well, we're very optimistic about young startups, and we're open for business. As you mentioned, we've invested in 15 seed and Series A companies since March 1st, and we're listening to about 500 new companies every month. And so there's a groundswell of innovation as people try to make sense of what the future might look like in a post-COVID world.
What sort of companies are you investing in?
We seek to partner with daring founders who build legendary companies from idea to IPO and beyond. And so we're looking for that enduring piece. We can't invest in companies that are just momentarily taking advantage of trends. So two of the recent Series A investments, one is a company called Vise with two young founders that are upending the wealth management space, and another company called Moz, which is helping students with financial aid. And these companies we think will benefit from COVID, but they really are meant to be long-term investments. We typically would partner with companies for a decade or more.
Roelof, have you seen private market valuations track the direction of public market valuations? Did it provide a lot of opportunities, or given that some companies, of course, aren't publicly listed, the premiums stayed pretty high?
Pricing in the early stage investment business is more of an art than a science, I've found. The later stage companies are the ones where we've seen activity slow down pretty significantly. And as you're seeing with the wild swings in the public stock market, people have a very hard time of forecasting the financials of these companies. For the ones that are benefiting from COVID, will it endure? For the ones that have suffered setbacks, how quickly will they recover? And so that area has slowed down. But in the seed and Series A stage, the very nascent company building, where companies are just trying to figure out product market fit and beginning to figure out go-to-market, they're not really that affected by COVID. And so there we find the activity has been very, very strong.
Just back to the black swan, though, message that you sent out in March, which I think resonated with a lot of people, especially because you guys did something similar back before the financial crisis. I mean, you told companies to look at doing more with less, potential layoffs, cash conservation. What have you seen across your portfolio companies in terms of how they're dealing with the economic fallout and what the expectation is of recovery?
I'd say by and large, our companies have weathered the storm. It's incredible to think that it was just 3 months ago when we issued that black swan memo, and some people were wondering why we were doing it. Unfortunately, many of our fears have turned out to be true. Some of the companies have benefited. Companies like Instacart and Robinhood, some of these portfolio companies have seen their businesses accelerate. And one of the things we've talked about is that COVID is accelerating the future that Silicon Valley has been building. Now, there's some companies that have had temporary setbacks, especially those that are exposed to travel or the events industry, but they took the advice, they've right-sized their cost structures, and all have shored up their balance sheets to make sure that they can survive and weather this storm.
I had a question, Roelof, about tech more broadly, not necessarily some of those smaller tech companies that we just showed that you guys are invested in. Do you fear, given the huge gains over the last decade, but also just over the last few months in big tech, that there's going to be a big regulatory pushback? And if so, which subsectors of the tech market are you most worried about?
That's an interesting question. I'd say in general, by nature, I'm an optimist because I work in venture capital, so I'm very optimistic about all the young companies that are able to move very nimbly in this period of uncertainty and change. The regulatory winds that were blowing pre-COVID, I feel like they're probably abating right now just because the tech industry has been so instrumental in helping the country cope with the impact of COVID. One of our portfolio companies, Zoom, has obviously enabled so many schools and businesses continue to operate. And so technology has played a huge role in our ability to deal with COVID. If you imagine 10 years ago, if this had happened, if we didn't have the sort of broadband infrastructure and all these wonderful software applications we can use today, I think the economic impact would have been much more severe. And so to some extent, there's a balancing of appreciating all the benefits that come from the tech industry.
Roelof, Instacart, which is another one of your companies that you invested early in, and today got a valuation of almost $14 billion, $13.7 billion, and I think another big fundraising round. How much of an anomaly is that because of just Instacart being in the right business here at the right time in terms of grocery delivery?
Well, there are a few of them. There's Instacart, there's DoorDash, there's Robinhood. There are a few of these companies of ours that have benefited from COVID. And as I mentioned earlier, we think of them as accelerating their future. One of our partners joked that for Instacart, Christmas came early, but it wasn't Christmas 2020, it was Christmas 2025. Clearly, the company was on a trend of enabling consumers to benefit from grocery delivery. But many people still weren't using this service, and COVID has exposed their capabilities to many more people that have been able to benefit from it. And so obviously growth has been very, very strong.
In terms of your point earlier that COVID has sped up the adoption of various things that Silicon Valley has been building for people for the future, are they going to be big cap beneficiaries of that, incumbent company beneficiaries, or do you think this is all a rush to private market companies like those that Sequoia has in its portfolio?
I think that many companies can benefit. Startups, because they can move so nimbly, can probably find little pockets of opportunity that are new. By definition, they move more quickly. So, Amazon obviously has a grocery delivery service themselves, but I think Instacart has out-executed them because that's the only thing they think about, the only thing they focus on every day when they wake up. But by the same token, cloud infrastructure has been a huge beneficiary of COVID, and people realizing that it's very difficult for them to continue to stand up their own enterprise infrastructure and data centers. And so Amazon maybe hasn't fared as well in the delivery space, but their cloud business, I think, is on a tear.
Roelof Botha, thank you very much for joining us with an update from Sequoia.
Thank you for having me on the show.
Adobe earnings are out. Josh Lipton has them for us. Hey, Josh.
So, Wilf, Adobe reporting Q2 EPS here of $2.45. The street was at $2.33. Revenue clocks in at $3.13 billion. The street was at $3.16 billion. As for guidance, Adobe saying Q3, they're looking for EPS of $2.40. The street was at $2.46. Revenue, they say, of about $3.15 billion is what they're projecting. The street was at $3.26. If you look at the segments here, digital media up 18% to $2.23 billion. That includes Adobe Creative Cloud, so the subscription service allowing customers to access Photoshop and Illustrator. Digital experience, $826 million. That's cloud offerings like advertising, analytics, marketing, and commerce. Interesting comment here from CEO Shantanu Narayan, who's saying the tectonic shift, he calls it, towards all things digital across all customer segments globally will serve as a tailwind, he says, to our growth initiatives as we emerge from this crisis. Guys, back to you.
Okay, Josh, thanks so much for that. By the way, this evening, don't miss Jim Cramer's exclusive interview with Adobe CEO, 6 p.m. On Mad Money tonight.
We've got some retail earnings out. Lululemon and PVH. Courtney Reagan with the numbers, Courtney, and a rare miss here for Lulu.
Yeah, Sarah, it is a rare miss. Lululemon putting up a first quarter earnings per share of 22 cents, missing by just a penny, but it counts as a miss here. And that marks a downtrend of 70% year over year, and the first earnings miss in more than 3 years for Lululemon. Same thing for revenue, the first miss in more than 3 years, with the first quarter revenue coming in at $652 million. The street was looking for $688 million, and that marks a decrease of 17% down year over year. No comparable store sales here, of course, with the stores closed the majority of the quarter, though the company does note the direct-to-consumer net revenue, so that's going to be your online sales, increased 68%. And here's what is very interesting. That means it made up 54% of total sales. That's up from just under 27% of total sales in the same first quarter for fiscal 2019. Gross margins also decreased there. That's something that's fairly rare for Lululemon, especially to this degree. They have about 60% of their stores open right now, and the company believes it has sufficient cash and cash equivalents to meet its liquidity needs. They are not giving any guidance at this point either. If we move on to PVH, you can check out the PVH earnings, a very wide miss, a loss of $3.03. The street was looking for a loss of $1.67. Revenue also just slightly light at $1.34 billion. The street was looking for $1.36 billion. Tommy Hilfiger revenue down 34%. Calvin Klein revenue down 46%. The company does say by mid-June, over 85% of its stores globally are expected to be reopened, and sales for reopened stores for the second quarter to date, so where we are right now, are running down approximately 25% globally compared to the prior year period. The company does expect that the second quarter impact and the full year results will continue to be weighed down here pretty substantially, though do also note that they have ended the quarter with $1.8 billion in liquidity, consisting of $800 million of cash on hand and $1 billion in available borrowing. Shares of PVH down 1%. Back over to you.
Yeah, and maybe helping cushion the blow for the Lulu miss, that direct-to-consumer revenue number up 70%, really strong e-commerce growth, maybe helping stem the tide there, Courtney. Checking on Lulu, down a little less than 6% after hours. By the way, Courtney, thank you. Don't miss Jim Cramer's exclusive interview with PVH's CEO tonight, 6 p.m. on Mad Money. Wilfred.
Still to come, Mike will have a look at Apple's huge rally this year and how that compares to various street expectations. Plus, Guggenheim's Scott Minerd warned of more bubbles to come just last month. We'll get his take on today's massive sell-off straight ahead here on Closing Bell.
Did you know that with TuneIn's local radio feature, you can stream live FM and AM stations broadcasting in your area? Discover local news, talk, and music stations. Navigate to the local radio section under Browse to listen locally on TuneIn.
Introducing a new podcast, ESPN Daily, hosted by me, Mina Kimes. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. The best sports story all day, 20 minutes a day, 5 days a week. ESPN Daily.
Search ESPN Daily to listen.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Cover coughs and sneezes with a tissue, then throw the tissue away. Avoid touching your eyes, nose, and mouth with unwashed hands. Disinfect surfaces, bottles, handles, knobs, and other places touched often. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Ready to talk brass tacks on what's happening in Major League Baseball? Turn to the Effectively Wild podcast from Fangraphs for daily statistics, analysis, and commentary.
One team will say, yeah, we're going to keep paying minor leaguers their stipend, and another team will say, we're going to extend the stipend through this month, and then another team will say, nope, we're cutting them off. So are extending it at least through August, which would basically be the end of the minor league regular season.
Search Effectively Wild on TuneIn to listen.
Looking for your daily fix of NFL news and analysis?
In that. So we had to blow it up and do Super Bowl predictions instead.
Look no further than the Pick Six podcast, where CBS sports writer Will Brinson gets you up to speed with what's trending in the NFL that day, so that you're always in the know.
Yeah, it's pretty revealing of Brinson's methodology for predictions. When he gets mad at people for predicting good teams are going to win the Super Bowl or good players are going to win major awards. That's how you wind up.
Search Pick Six on TuneIn to listen.
The world's most comfortable home office with XChair. Call or click to order today and receive a 30-day risk-free trial and $100 off.
On Squawk Box, Elon Musk and Tesla on a tear. The space launch, soaring stock price, raising the stakes for electric vehicles. Inside a company climbing for more. Tomorrow, watch or listen live on the CNBC app.
Here you have a company where 200 million iPhones, you can pretty much underwrite in a year where 5G is getting launched, services is going to grow, wearables is going to grow. So the visibility of that 50 or 60 billion in free cash flow that they're going to deliver next year is a real number. And people having that visibility is worth a lot to the investment community at this point, given that every other option that you look out there, most other options that you look out there, there is a tremendous amount of uncertainty with regard to how those cash flows are going to play out.
Bank of America's Apple analyst earlier on CNBC today explaining why he bumped up the price target on Apple to $390, which was a new high on the street. Let's go back to Mike Santoli for a closer look at that Apple price. Mike.
Yes, Sarah, and a closer look at the Wall Street sentiment toward Apple. You know, that's a plausible case that Apple enjoys a lot of visibility. The big question is it already baked into the stock price, analyst sentiment, and the valuation? So here you see a pretty rare situation where the share price of Apple, and it was down 4.8% today, but a full percentage point better than the S&P, so it's a little lower now. But this is a very big premium of the stock price to the aggregate consensus price target of Wall Street, which is about 320 right now. That's an unusual situation. What usually means is analysts reassess. If they don't want to downgrade the stock, they have to find a way to raise their price target and essentially justify that call. And so you're likely to see some price target increases and some upgrades as we get through this little period here, unless the overall market completely falls apart. And it'll be interesting to see if the stock responds to that. Now, valuation-wise, we are at pretty much by far multi-year highs in terms of forward price earnings multiple for Apple. Now, not quite relative to the market are we at an all-time high. That's because the overall market valuation has really expanded as earnings for everything else have collapsed. But I do think here, again, it's a test. We do get that quality premium for Apple when times are tough. We get the growth premium when nobody else sees growth anywhere. And, of course, the kind of balance sheet strength in turbulent times. So all that stuff is out there in favor of Apple. Question is all of it already reflected in what the market's recognized already, guys?
Yeah, it has been quite the run-up. Mike, thanks. We are in an asset bubble. That is investor. We're going to ask him next.
The station you're listening to is experiencing technical difficulties.
Trey Wingo here from ESPN's Golic and Wingo. Every morning, Mike Golic Jr. and I sit down to discuss all the news, drama, and highlights spinning the sports world that day. And with TuneIn, you can hear us whenever and wherever you go. Just search Golic and Wingo and start listening today.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
As global COVID-19 cases continue to tally in the millions, local and national governments are trying to limit the spread, while scientists race to develop a vaccine.
So we're going to start manufacturing.
The news is always changing. Luckily, TuneIn always has the most current updates and stories, featuring live streams of CNN, MSNBC, Fox News Talk, NPR, the BBC, and more. Plus, the latest episodes of your favorite news podcasts. Search Coronavirus News to hear what's happening now.
People achieve their financial goals.
What did we decide on the flyers again?
15 minutes could save you 15% or more on car insurance.
5 years of savings and service.
What, we're just going to swap over?
Yep. Pump the brakes on this, swap it over to that.
Pump the brakes and swap over?
That's right.
What, instead of all this I've already...
Yeah.
What are we going to do with these?
Keep it in your desk, save it for next time.
Geico, over 75 years of savings and service.
Getting back to business relies on giving customers the confidence to walk back through your doors. It's no wonder so many are putting their trust in ServPro, #1 choice for cleanup and restoration. With ServPro, our expert cleaning helps reduce the spread of viral pathogens. This goes way beyond janitorial cleaning, adhering to CDC standards and using proprietary EPA-approved disinfectants. Put the certified ServPro Clean Shield in your window and tell customers you're committed to a higher standard of clean. For a free quote, visit servpro.com.
An ugly day for the market. The Dow down nearly 1,900 points. The S&P 500 closing down almost 6%. The worst day for the major averages since March 16th. Here were three things driving the action in today's market today. A surge in new coronavirus cases in parts of the U.S., dampening hopes for a swift economic recovery. We saw a sharp reversal of the reopening trade as travel, cruises, retail, and energy closed sharply lower. The worst performers in the S&P, Norwegian Cruises, Boeing, Occidental, United Airlines. And after a dour forecast from the Federal Reserve, Treasury Secretary Steve Mnuchin dug in his heels in terms of the reopening, saying, quote, "We cannot shut down the economy again."
For more on today's sell-off, let's bring in Scott Minerd, Global Chief Investment Officer at Guggenheim Partners, who joins us now by phone. Scott, very good afternoon to you. Thanks so much for joining us.
Oh, thanks for having me today.
Clearly a crazy roller coaster in terms of today's market moves, but all in perspective off a very strong market bounce. Do you think this pullback today was warranted?
I think so, Wilfred. I think that the run-up that we've had since March the 23rd was really built off the back of the Fed liquidity that was provided to prop up the markets. And when you consider that S&P earnings, estimates are ranging between $80 and $100 a share, a multiple of 30 times, which is roughly where we're sitting today, is exorbitant. It's the sort of multiple you would get in the internet bubble. So, clearly valuation is high. Now, as I always tell people, valuation is a poor timing tool. But the other thing we have going for us is the seasonals, and that is that the old adage of sell in May, go away, been proven to statistically work. And so from a seasonal standpoint, we should be expecting downward pressure on markets going into, the late summer. So, I think the recent highs have been a selling opportunity. And I think we're going to have a tough slug going here, especially with the increasing number of COVID cases and that are coming up as a result of the reopening.
So a selling opportunity, Scott, is different than a bubble. Are you calling the stock market a bubble?
Well, I think if the stocks are trading at 30, maybe 35 times earnings, that yes, it's a bubble. Those sorts of valuations are really historically extreme, and in all likelihood end in tears. So I think we're seeing that. I did a call the other day on the leadership committee of the Milken Institute, and Mike Milken made a comment that this would be a good time to sell some stock and delever your company. The valuations relative to the earnings prospects are really high, and the chances of disappointment are great.
Scott, but clearly, as you've already alluded to, there was enormous government support and rates are going to stay low for a long time. How much more of a little pullback? We had 7% just today on the Dow. Does that make you then change your mind on that again? And I guess paired with that is, to what extent do you think it was retail investors that pushed us the last leg higher, and how much lower before that factor has been removed again?
Well, it's interesting, Wilfred, because institutional money, by and large, fought this rally all the way up, some of the smartest money in the world. And people, I noticed, were starting to change their positions on the institutional side and buying into the rally and saying, you can't fight this. That to me sounds like the classic throw in the towel, I've been wrong, I have to be long. And Wilfred, when you look at the charts here, the S&P, I think, is quite telling. We have broken clearly through the uptrend that was in place since March the 23rd. And so our next level of support, is, not dramatically below where we are, but it's not broad support. That support would be somewhere in the neighborhood of 2750. But I honestly think that we probably go back and retest the lows, and history shows us that it's very likely that we'll undercut the lows and get to levels that I've talked about before, which are maybe as low as 1600 on the S&P.
You may be right, Scott, and clearly, you've got the case there. My question is, haven't you been bearish this whole time? You were on with us in May on CNBC also saying, the darkest days are ahead for stocks. And,
right.
If you felt that way the whole time, you would have missed a more than 40% run-up in the market.
Well, to be honest with you, Sarah, the way that we played it was to buy high yield and corporate credit. On March the 23rd, we reversed our positions and went long. If you look at the correlation between corporate credit and high yield to stock prices, it's extremely strong. And this is where I think the dilemma is coming for the Federal Reserve. The correlation between credit spreads and stocks is extremely tight. And so this sell-off, which is now also resulting in a sell-off in the high-yield market and the corporate bond market, clearly is not what the objective of Fed policy is, which is to push those spreads in. So the difficult question in my mind is, will the Federal Reserve try to intervene directly to prop up stocks if this continues and the corporate bond market continues just as it has today? But in terms of fighting it, I will tell you that, yes, we did buy stocks on the 23rd. We didn't buy nearly as much, but we did go overweight dramatically in high yield and corporate credit. And to be honest with you, the biggest challenge I face today is, do I use this opportunity or strength that might come in the next day or two, because markets very seldom go straight down, as an opportunity to reduce our exposure, and that is probably what I'll be thinking about for the next 24 to 48 hours.
But Scott, you said S&P could go to 1,600, so it could almost half from here. I mean, if that's a possibility, I'm surprised that you don't already have zero weighting to equities and have 100% weighting to gold.
Well, one thing that, Wilfred, is that it's important in portfolio theory to maintain diversification. That is that the correlations between assets are not one. That is that if some assets go up, others go down. I'm not omniscient. I just can basically look at valuation and say, and the economic environment, and make judgments as to what I think the right prices for securities are. So, you could say I should be 100% out of equities, and look, it's a fair comment. But in the way we manage our clients' accounts, what we try to do is minimize the risk of drawdown, which means you have to have negatively correlated assets along with your other investments. And we do have a substantial position in silver and gold. So you are right, and we have a lot more silver and gold than we have in equities, and it's been a trade that's worked at least to date.
Scott, thanks for joining us.
Thank you.
So to come, we'll dig into the reversal of the reopening trade. Norwegian Cruises, United Airlines, and Wynn all plunging today. We'll also take a look at a few stocks that outperformed after the break.
The Woj Pod with Adrian Wojnarowski.
Doris, you had reason to believe that you needed to get a test for the coronavirus.
Right. Well, let's just start with the headline, which is I did test positive for COVID-19. I was so tired from Saturday the 14th through Tuesday, March 17th. I kid you not, I could not be out of bed for 5 minutes without needing to go back to bed and lay down.
Search the Woj Pod to listen.
Your app to help you get organized. Stifel Wealth Tracker combines your accounts, builds your personal balance sheet, and tracks your net worth. So organize your finances with Stifel Wealth Tracker and stay safe.
The rollback barometer. States on the mend, facing nationwide unrest, progress reports for a COVID cure, and rough times for commercial real estate. Stay connected, stay informed. Watch or listen live on the CNBC app.
Stop overpaying for home and auto insurance. Go to Gabi.com. Gabi compares your current rate and coverage against top providers, saving customers over $800 a year on average. See how much you can save at Gabi.com.
This isn't dry food or wet food. It's not burnt brown pellets. The farmer's dog makes it simple to feed your dog real food. It's real meat and veggies. Freshly made, developed with vets, delivered right to your door. That's why dog lovers are choosing the farmer's dog. A smarter, healthier pet food. Delivered. Visit tryfarmersdog.com and get 50% off your first box of food.
This is the Ridge. It's the closest to perfection wallets are ever going to get. It comes in a dozen different colors and materials with a cash strap or money clip. Get your discount today at ridge.com.
Time now for a CNBC News update. Sue Herrera has it for us. Hi, Sue.
I do indeed, Will. Thank you very much. Here's what's happening at this hour, everyone. President Trump is telling Washington Governor Inslee and Seattle Mayor Durkin to take back their city now or he will. This in reference to the Capitol Hill Autonomous Zone set up by peaceful protesters in Seattle. Police have largely withdrawn from the area. Responding to earlier Trump tweets on the subject, Durkin tweeted, "Make us all safe. Go back to your bunker," end quote. Democratic presidential candidate Joe Biden setting out an 8-point economy restart plan. It calls for improved testing, more than 100,000 contact tracers, as well as new protections for workers and aid for schools and child care centers. You can go to CNBC.com to read more on that plan. And another positive note to give you, SeaWorld's flagship theme park in Orlando, Florida, reopened today. Visitors are required to wear face coverings and have their temperatures checked before entering. Busch Gardens Tampa Bay also opened for the first time since March. You are up to date. That's the news update this hour. Sarah, I'll send it back to you.
Sue, thank you. Still ahead, peering inside today's major market sell-off, the stocks and sectors making the most dramatic moves. When Closing Bell comes right back.
The Mina Kimes Show podcast.
Kevin Clark.
If Josh Allen became the 10th best quarterback in football this year, they'd probably win 14 games. Am I wrong about that?
No. If you as a quarterback can't win in the Bills' situation right now, they should not extend you. So many teams, Jets, do not have the information they need to evaluate their quarterbacks based on the teams they built around. The Bills do.
Listen and subscribe to the Mina Kimes Show podcast.
Search the Mina Kimes Show to listen.
There's a lot of sameness among online brokers these days. IBKR stands out in the crowd. We offer the lowest trading and borrowing costs. Our clients have the choice of investing globally or locally in stocks, options, futures, Forex, bonds, and funds from a single integrated account. Our premier technology enables you to optimize speed and efficiency, perform sophisticated portfolio analysis, and manage your accounts. Start investing today at IBKR.com.
My name is Oscar, and I deliver packages for Amazon. I recently took a break because my girlfriend and I just had a baby. There you go, sir. And when I came back, Amazon completely changed. If anything, they took it overboard on the safety, and that's what I love. We're all working towards a common goal. Just like Amazon says, deliver smiles, and honestly, I believe I do.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
A huge sell-off on Wall Street today. The Dow closing down nearly 1,900 points. Worst day for stocks since March 16th. Only one stock closed higher in the S&P 500. That was Kroger. Let's look at some of the day's biggest movers. Seema Modi looking at travel, Contessa Brewer watching the casinos, and Deirdre Bosa digging in on the work from home trade. Seema, though, first to you.
Yeah, Sarah, a major reversal in travel stocks today. And in some ways, it reflects what Marriott CFO told us just a couple weeks ago, that the rebound in travel would depend on the containment of the virus. And with the recent uptick that we're seeing in select states, this travel trade is unwinding. I'd also point us to the latest data we have on hotel occupancy, which shows, yes, occupancy is improving, but still well below the 61% average we were at prior to COVID-19. On to the cruise lines. Big run up in recent weeks. Today, the biggest laggers on the S&P 500, led by Norwegian Cruise Line, down as much as 16%. The cruise line CEOs met with the CDC today, yet still no guidelines as to whether the health officials will lift that no-sail order that's still in place till the 24th of July. Guys, back to you.
Seema, thanks very much for that. Let's also get a check-in on casinos. Contessa Brewer has that for us. Hey, Contessa.
Hi there, Wilfred. Yeah, worries over rising coronavirus cases, recession, and unemployment
and maybe the opportunity to take some profits here are weighing on casino stocks today. El Dorado, the laggard of the group, down 16.5%. If we take a look at Penn, and boy, these regional casinos really got hit today. Penn down 11%, Boyd off by almost 10%. MGM Resorts, one of the laggards, down 13%, and then Wynn Resorts down more than 9% as well. Over 1 month, El Dorado and Penn are still up, though, almost 80%, and the rest of them solidly in the green. Sarah?
Contessa, thank you. Deirdre Bosa taking a look at the so-called work-from-home trade. Dee.
Hey, Sarah, mixed picture among some of the darlings of this trade. Take a look at Zoom, continues to just gain. They were up, let's see, in the session, they were up about 7%. You're looking at the after hours now. Year to date, gains of more than 225%. And that comes even as it comes under some more scrutiny over the last week over censorship issues. DocuSign also gaining today. Those shares have doubled this year, but take a look at Slack. It has sat out the rally today, the work from home rally. Now, since reporting its earnings last week, they disappointed investors. So they are down some 20% over the last 7 days. Year-to-date gains, though, still pretty strong, up about 35%. Back to you guys.
Dee, thanks so much for that. We've got some breaking news on the IPO front. Leslie Picker's got it for us. Hi, Leslie.
Hey, Will, if that's right, they keep on coming. I have several sources telling me that Quicken Loans is preparing an initial public offering for this year. People familiar with the matter say the company has filed its IPO prospectus confidentially and may flip it to be public as soon as next month. The targeted valuation is still being decided, but it's likely in the tens of billions of dollars. That implies a multi-billion-dollar IPO, and I'm told it will be one of the largest, if not the largest IPO in the U.S. this year. Now, the company is working with Morgan Stanley, Goldman Sachs, Credit Suisse, and JP Morgan on this offering. They are the largest mortgage lender in America, founded by billionaire Dan Gilbert. The company and all four banks declined to comment on their plans for an IPO. Our full story about the Quicken Loans IPO is on CNBC.com. Guys.
Will be a really interesting one, Leslie. Thanks very much for that, and interesting also just to see a couple more of these IPOs start to sneak out. Coming up, a surge in new infections and hospitalizations in states from Arizona and Texas to North and South Carolina on the East Coast. Why it's happening and how it will affect the economic recovery. That's coming up next here on Closing Bell.
Hi, this is Mike Tirico, introducing you to Sports Uncovered, the newest podcast series from the storytellers at NBC Sports that will shine a fresh light on the most unforgettable moments in sport.
The reason why I'm smiling, I might get in trouble for this.
Search Sports Uncovered to start listening today.
Dollars instead of paying thousands. All commission-free online. Schwab Stock Slices, an easy way to start investing or to give the gift of stock ownership. Schwab, own your tomorrow. We hope our digital solutions make banking easier. Deposit checks, check balances, pay bills, and more. Explore all you can do with our digital tools from almost anywhere. PNC Bank.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
In an era where we're afraid to touch cash or hand over our credit cards or type on potentially COVID-encrusted keypad, Shedder, Apple's Pace contactless technology has become a necessity. Honestly, watch or listen live on the CNBC app.
Just always thought dog food is dog food. Didn't really piece together that dogs eat food. As soon as we brought the farmer's dog in, her skin was better. She was more active, high quality poops. If I can invest in her health and be proactive, I think it's worth it.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
Download the free app now.
The station you're listening to is experiencing technical difficulties.
Up next, a surge in coronavirus cases was a big part of the big sell-off in stocks today. We're going to dive into those state numbers and talk about what they mean. Plus, as we head to break, take a look at the massive market cap moves today. Apple, Microsoft, Alphabet, and Amazon all shedding tens of billions of dollars amid the sell-off. Closing bell, we'll be right back.
Incomparable design makes it beautiful. State-of-the-art technology makes it brilliant. The Lexus NX. Experience the crossover in its most visionary form. Experience amazing at your Lexus dealer.
Land Rover, above and beyond.
Born from discipline. Consistency rewards. Columbia Threadneedle Investments.
You can't predict the future, but a resilient business can be ready for it. A digital foundation from VMware helps you redefine what's possible now. From the hospital shifting to remote patient care in just 48 hours, to the university moving hundreds of apps quickly to the cloud, or the city government going digital to keep critical services running. You are creating the future on the fly, and we are helping you do it. VMware, realize what's possible.
Preparing the workforce for the future, an at-work spotlight event, June 18th. Exploring new technology with top CEOs, reshaping business for the path forward. To join us, go to cnbcevents.com. Sponsored by T-Mobile for Business.
Cases of COVID-19 in the U.S. surpassing 2 million as the economy reopens. And we're seeing hotspots in regions of Texas, Florida, and Arizona as the daily average of new cases week over week in those states surged 15, 40, and 49%. Stocks like Exxon, Southwest, Darden, and Simon Property all getting hit hard today over concerns of a rise in new cases. Joining us now, Dr. Philip Ozwa. He's the president and CEO of Montefiore Medicine, which is made up of 11 hospitals and 200 outpatient facilities in Bronx, Westchester, and Hudson Valley, New York. Thank you for joining us, Dr. Ozwa. I mean, you've had great experience now with COVID-19, treating it head on. Why do you think we're seeing these cases and hospitalizations rise in certain parts of the country that have reopened, but not in others as much, like Georgia, or even in other countries in Europe and China and the rest of Asia?